File an extension. I file an extension every single year. I have probably filed an extension every single year since 1999. You hear what I said? I never send my taxes in on time. I'm not worried. I'm not going to pay any taxes, or I'm not going to realize a tax consequence because of all the depreciation and everything that I talked to you guys about yesterday. But we file our taxes on October 15th and September 15th of every year. Why? Because typically what is said is that there's a lesser rate of chance of audit. That doesn't mean you won't get audited, okay? But you kind of lessen or minimize your chances of being audited when you send the taxes in later, okay? All right. And like I said, all I'm doing is just kind of revisiting and summarizing some stuff. We talked about paying yourself out of your LLC. And we talked about if you just had just an LLC that was not an S corporation election, then basically you just paid yourself from the LLC. All that money comes to you as personal income. And all of that money would be subject to self-employment tax unless you're doing a passive activity business, all right, such as real estate. Real estate rental income is not subject to self-employment tax. Remember that. Real estate rental income is not subject to self-employment tax. All right. And remember, guys, when you pay yourself, you're just making a member draw each time. That's a member draw. You're just writing yourself or transferring money to you personally. Now, for most of you or some of you that are wholesalers, we talked on yesterday that if you're electing to be an S corporation, which I highly recommend for most of you, particularly if you're doing more than 7 or 8 transactions a year, then you're going to elect to have an LLC taxed as an S corporation. All right. And you're going to pay yourself a reasonable salary out of your earnings. And we're going to pay yourself dividends. The reasonable salary part is subject to self-employment tax. And the dividends that you pay yourself are not. Remember, the dividends that you pay yourself are not subject to self-employment tax. All right. Now, I made a suggestion to you on yesterday. You need to get with your bookkeeper or accountant or payroll person and have them set this up for you if you're in the S corporation. You want to make sure, you can elect to do it however you want to do it, but this is just my recommendation. Throughout the year, as I said on yesterday, pay yourself in dividends for the entire year. And that way you avoid paying payroll on a quarterly basis. All right. You're not having to do payroll accounting on a quarterly basis. You pay yourself dividends for the entire year. And then in December, you go back, look at how much money you actually made, because you don't know how much money you're going to make till you get towards the year end. Then you can decide how much I'm going to allocate to distribution, how much I'm going to allocate to salary. All right. Because you don't want to pay yourself all salary and then find out now you just subjected yourself to more self-employment tax. So if you wait till the end of the year, you're going to make a determination. Again, if you made $100,000, maybe you're going to pay yourself a $20,000 salary and have $80,000 as a dividend. All right. And then you're going to file your quarterly tax report on or before that scheduled due date that actually gives you the ability to capture the amount of actual salary that you took. All right. Remember, you cannot go and try to classify all of your money as dividends or distributions. Okay. You don't want to, you can't just make distribution without having considered that it has to be a reasonable salary. All right. Remember, we said that yesterday. It has to be a reasonable salary. So you want to be able to justify why you made $500,000 and paid yourself $10,000 in salary. All right. So you know where you're at. All right. We talked again yesterday, just reiterating a little bit on the things that are going to make you some money. I want to go back over those because these are things that you need to make special notes on. You guys, again, for all of you folks that want to actually do this business and you are concerned and worried about right now you're a single member LLC and you want to change that. I told you on yesterday that you want an LLC taxed as a partnership. So to achieve that objective, you can form a company. A favorable place to form that company would be in Wyoming. And what you're going to do is form a C corporation in Wyoming that provides your company, your LLC, strategic investment and marketing advice. Remember, this answers the question for many of you who desire to be an entrepreneur and you're working for yourself and you're trying to figure out, how do I have a benefits package if I'm working for myself? How do I have health insurance? How do I provide for my family in those regards as a self-employed person? This is your answer and response to that. So once you set up that Wyoming C Corporation, you remember, let's just say you made $100,000 in your LLC. You're going to pay a guaranteed payment from that $100,000. So what you're going to do is, in your operating agreement, you're going to say that in your operating agreement for your LLC, you're going to say that that LLC is responsible for making a guaranteed payment to your C corporation on an annual basis. And you're going to determine the amount of that guaranteed payment by how much money you actually need to fund all of your benefits packages. All right. The amount of money that you put in that corporation is going to be determined by the amount of money you need to fund your benefits packages. All right. So if we determine that we needed $30,000 to fund our benefits package, we're going to pay $30,000 to the Wyoming C Corporation. All right. Once you paid that money to the Wyoming C Corporation, then of course your gross earnings in the LLC partnership are now $70,000. So we reduced income. All right. Remember that we reduced income, guys. Remember what all we're doing now, guys. We're taking money out of the left pocket and putting it in right pocket and getting a tax benefit for it because it's still our money. That $30,000, don't look at it like, hey, well, I'm paying this company $30,000. You're paying yourself $30,000. All right. So that means you're going to pay less taxes on your LLC partnership. You're paying taxes on $70,000 now rather than $100,000. All right. In your Wyoming C Corporation, it's going to have income. The only income it's going to receive for the entire year will be those $30,000, which was your guaranteed payment. You're going to pay yourself a small salary that you determine. Now you actually have W-2 income. Remember I told you yesterday, banks love W-2 income. You go in there for W-2, they're smiling. You go in there with $5 million worth of assets, they want to see everything else, right? So you're bankable. You got W-2 income. All right. Then you're going to form your benefits packages. You're going to form your 401k. Because you work for this great company that not only do they make a contribution to your retirement plan, they pay the entire amount because you work for this great company, which only you and your spouse are going to be in that company that you're paying this. Now, I didn't say this on yesterday, so I want to make sure you understand this. If you set this up and you have other companies that you actually have employees in. This is important, so make sure you note this. If you set this up and you have another company or other companies that you actually have W-2 employees in, then you're going to have to be responsible for paying them benefits as well. So you got to figure out a way how you can do this. If you do this for yourself and you have other employees, then you can't set up something for yourself, and the government frowns on that. You can't set up something for yourself that you're not offering to others. All right. So this works great if you're just a mom and pop, husband and spouse operation, and you don't have W-2 employees. Now, this is full-time salaried employees now. So if you have employees working less than 30 hours a week, then you can set this up without providing health benefits. So if you have employees working part-time, then you don't have to worry about providing benefits to them. Everybody follow me on that? Want to make sure that's clear. Okay. All right. So you set up and have your 401k funded by your Wyoming corporation. Then you also, if you wanted a self-employment pension plan, which you can contribute up to like almost, I think it's $58,000 something this year, you can contribute to your self-employment pension plan. So you can have your C corporation fully fund that. So if you were really rocking and rolling, you wholesaling, you're making a whole bunch of money, you could actually do this to get rid of some of that money and put it back in your pocket, okay? Because you're going to be funding your retirement plans, all right? Then you also had the last one, you had your health savings account. So if you were worried about health insurance, this is where you call in to insurance companies that are offering insurance plans or company benefits packages. That you get them to explain to you the cost of those packages. Fidelity Mutual Insurance, Concordia. There's a whole bunch of different insurance providers that can help you with these benefits packages. All right, so you're going to do your health savings account. So you're going to fund that out of that $30,000, whatever amount that costs. And then last but not least, all right, you're going to also get the benefit of renting your personal property. You're renting your personal property, your house, to your business for up to 14 days a year maximum to have business meetings and conferences. All right. So you can basically utilize your personal residence, as a place that you hold your meetings and conferences, and you're going to have your corporation pay you for the rental or the leasing of your property. And remember, I said that you're going to do that. You're going to need to go to one of your local hotel, convention centers, or whatever that hope that you can have, that would give you the ability to have a nice conference. You're going to go there. You're going to have them give you an estimate of what it would cost to rent out conference space for 2 days. If you're going to hold a 2-day conference, all right, you want AV equipment and all that good stuff. And, like I said, if it was yesterday, if they tell you it's $1,000 a day, then that means that you're able to get, that's $14,000 right there that you're paying yourself. $14,000 that your company is paying back to you personally. All right. Remember, I said that your company is paying that back to you personally. Also, when you do that, you can write this down. That money is not taxable. You can see IRC code 280AG. IRC code 280AG. That income derived from that personal leasing of your residence is not taxable, provided you do it for less than 14 days a year for business purposes. So guys, I think yesterday in the illustration I used yesterday, I said if you did $1,500 per day times 14 days, that's $21,000. So just think about that. If you knew you were going to do that, I would tell you, look, after you sat there and figured out your benefits package, I would go back and look at how much money I actually needed to, you might go back into your LLC partnership and fund some additional money just so you can put that back in your pocket. How many people think that's sweet? All right, and last but not least, before we get into our personal property trust again, we want to talk about, again, the other true benefit was hiring kids in our business. So we talked about age 7 to 17. You're giving your kids money for school, to buy iPads and computers, and every time they want to do something, going to camp, they want to go to Boy Scout camp. You tell them you pay for your own Boy Scout camp because you're going to pay them a salary, or you're going to put them on payroll. Remember I said yesterday that you actually have to employ them. You're going to put them on payroll. So you're going to have to do payroll taxes on them. Okay, you're going to turn in the payroll on them, but they're not going to have any taxes. Remember that I said that for this year, you can pay each child up to $12,400. Each child, you can pay up to $12,400. That's a biggie. If you had 3 kids, what does that do for you? Think about it. That's $37,200 that you got to write off. Well, you don't get to write off the whole amount, but you get to pay your kids and get a tax benefit from it. All right. So remember, if you were paying your kids one child $12,400, that results in a $4,625 tax savings for you, depending on your individual tax bracket. $4,625. Right now, if you spend $15,000 on your kid over the year, you don't get nothing. You get no write-off whatsoever. So if you do this, then you're actually putting money back into your household. All right. Remember, I said that you have to pay them no more than you would pay any other reasonable person that you hired performing the same task. So, you can't have little Johnny taking out the trash and paying him $12,400 because he took the trash out one time. Okay. We said that if you had minor kids younger than age 7, then you can do what I illustrated to you yesterday. We're all in the real estate business. I said you might want to take them outside in front of a nice property, put a for sale sign out front, and take a nice pose with your kid, and put it on your website, and pay little Johnny, little Susie a modeling fee for having modeled. That just in itself, guys, I'm telling you, is worth the price of this of coming here this weekend, particularly if you have children, and if you were looking for a way to set up benefits package for you as an entrepreneur. Okay, let's go back. I'm going to show you. I talked a little bit yesterday. Before we go on, I'm just going to show you this. I'm just kind of just throwing everything at you because I want you. These are things I want you to take note of because these are things I want you to actually go back and find when you start talking to your CPA, talking to your tax strategists. These are things you want to know if they're able to do these things and perform these things for you. What you see illustrated there on the screen is a depreciation form. It's a form that illustrates depreciation on your property. If you look in that thing, it's showing that on that particular property, we're depreciating the roof, the air system, the furnace, the sewer, the driveway, the sidewalk, the bushes, the trees, the outdoor shed, the carpeting room by room, the stove, You know, so we're going like, so that's what's being depreciated, guys. So, and so that's the kind of stuff you want to see, because like I told you guys yesterday, you're trying to build up that depreciation bucket that I talked about so that you can minimize or eliminate your tax consequences. Here we go again. Here goes your Form 8825, where all of these expenses will be shown or depicted. On that Form 8825, I illustrated this to you yesterday. The highlighted line down there in line 14 has the depreciation. You know, the depreciation is going to get added back in. All right, the depreciation gets added back in. Remember, guys, when you're in business, you're thinking and strategizing for business, and you're doing this in a manner that is going to give you the highest and best ability to avoid or at least minimize paying a boatload of taxes. Remember what we said yesterday, that on average, if you're wholesaling properties, you're looking at about a 42% tax bite. I don't care what tax bracket you're in. 42% overall effective tax bite. So think about that. You want to minimize your tax consequences. You can come back to me, Dave. All right. So I want you to understand that when you hear me say that I can go out here and sell a house and get a big fat check and I didn't pay any taxes. No, I want you to understand, it's not that I didn't pay any taxes. It's not that I actually didn't pay taxes. It's the fact that that depreciation bucket, this is just for your sake. Once again, if you can make this depreciation bucket as big as you possibly can because you have something on your board, then if you can make that depreciation bucket, say $500,000, right? Then everything you do from a selling standpoint, all right, every house that you sell and make a profit off of, that $500,000 is going to take away that $500,000 of phantom expense, is going to detract from that gain that you got on the sale. So if you sold a $100,000 house and you would have had a 42% tax, then that 42% tax really came out of your depreciation bucket. Everybody follow me? That $42,000 came out of this. So now you still have $460,000 or $458,000 left. So it's not that you're not paying taxes. It's just being expensed out because you have a loss or phantom loss on the other side of your business. That stuff is key, guys. That stuff is key because that's going to keep you from looking like that come tax time. All right. If you do what I'm telling you right now, that's going to keep you from looking like that. All right. And I know some of you are going to be looking like that, particularly if you've been wholesaling a whole bunch of properties and you haven't been keeping a good account of what you're doing. All right. Okay. What I'm going to do now, we're going to take 10 minutes and then we'll come back and we're going to start with the personal property trust. So let's take a 10-minute break, get right back here, and we'll start with the personal property trust.